Hi everybody, it's Peter Schiff. It is Saturday, October 16th, 2010. Well, the week ended another down week for the dollar. The dollar index has now dropped for 5 consecutive weeks. Against Asian currencies, it's 7 consecutive weekly declines for the US dollar. On the stock market front, markets were relatively firm. The U.S. market underperformed global markets. I think the S&P was up just under 1%. Contrast that to the Hang Seng, which was up about 3.5% on the week. Bonds had a very, very bad week. The 30-year yield rose above 4% for the first time since August. The 10-year yield was higher as well. The 30-year bond broke a very key trend line. It might be a leading indicator for the 10-year. We'll have to watch interest rates very closely next week. There was a very weak auction, a Treasury auction that was held late in the week. It shows the U.S. government is having a very difficult time selling its bonds. The weakness in the dollar is one reason why. Taking a look at some of the currencies that the dollar fell against on the week, the Chinese yuan, the dollar hit its lowest level against the yuan since 1993. The dollar almost hit a record low against the Japanese yen. We traded below 81 for the first time since 1995. The dollar is now lower against the yen than it was following that high-profile intervention by the Bank of Japan. The dollar hit a 20-year low against the Singapore dollar. And in Singapore, we had a very interesting development in this currency war. It seems that Singapore has actually surrendered because Singapore announced that it is going to be increasing the band in which its currency trades. It's going to allow its currency to strengthen against the dollar to restrain inflation. In effect, Singapore is now tightening monetary policy and allowing its currency to rise. I think that's very bullish for Singapore and the entire Asian region, because I think it takes some of the pressure off other countries to debase their currencies. So in other words, while Asia is surrendering, the U.S. is poised to win the currency war, which means American citizens lose. Looking at the Australian dollar, hit a new record high this week, trading above parity against the U.S. dollar for the first time ever. In Europe, the Swiss franc, record high, which means a record low for the U.S. dollar against the Swiss franc. Metals, gold was up over $20 an ounce on the week. That's despite falling $10 an ounce on Friday. Silver continues to be stronger than gold. Silver gained better than $1 full an ounce this week. Also later in the week, probably contributing to the weakness in the dollar, the weakness in bonds, the strength in gold, was Ben Bernanke himself, who gave a speech. I believe it was on Friday morning. In his speech, Ben Bernanke lamented the fact that inflation remains too low, and he assured us that he is going to do whatever he can with quantitative easing to make sure that inflation picks up. Now, the reason that Ben Bernanke is concerned about the low level of inflation is because unemployment is too high. Now, in Ben Bernanke's mind, there's a trade-off, something called the Phillips curve, between unemployment and inflation. And Ben Bernanke, if unemployment is too high, well, he thinks it must mean that inflation is too low. And if we can simply produce a higher rate of inflation, we will miraculously create more jobs and have lower unemployment. Well, this is all a bunch of Keynesian nonsense. There is no trade-off. If anything, when you have high employment and low levels of unemployment, you tend to have lower prices because you have more productivity. What Ben Bernanke doesn't understand is that unemployment is high for a lot of reasons, many of which are beyond his control. A lot of them have to do with regulations coming out of Washington that are destroying jobs, that are making it expensive for people to hire. The way we create jobs is by shrinking government. We have to repeal all the laws and regulations that interfere with the free market, that create unemployment, that make it difficult for businesses to hire. We need lower taxes, which means we need less government spending. We actually need higher interest rates to encourage savings so that capital is available to Main Street, not just Wall Street. But none of this is going to happen with Ben Bernanke. In fact, quantitative easing guarantees bigger budget deficits and more unemployment. Because when Ben Bernanke tells Congress, I'm going to buy treasuries, I'm going to print money and use it to buy treasuries, what he's telling our leaders is, go ahead and run big deficits. There's no need to cut back on government spending. You can spend till your heart's content. You can promise anything to get elected because I'm going to monetize the debt. And that is exactly what's happening. And so the result is going to be even more unemployment, and we're going to get higher inflation to boot. And of course, the crazy thing about what the Fed is doing, in Bernanke's speech, he actually said that he thinks 2% inflation is ideal, or that's his target. Well, if he's targeting 2%, he ought to be happy with 1.5%, but no. Because if you look at this CPI year over year, and I think this still understates inflation, but according to the CPI, prices have risen 1.5% in the last year. Now, if Bernanke is really targeting 2%, he ought to be happy with 1.5%. Does he really think he can just crank it up a bit, dial it up a notch from 1.5% to 2%, that he knows the exact number of treasuries that he needs to buy to produce a 2% rate of inflation? I mean, that's crazy. You cannot fine-tune it like that. If the Fed is really trying to increase inflation from 1.5% to 2%, they're going to overshoot by a landslide. And you got to realize that back in the 1970s, when Nixon imposed wage and price controls, he did it when the CPI was running at 4%. So here you have Ben Bernanke, 1.5%. He's going to take a shot at quantitative easing because he thinks he can ramp it up to 2%. What if he hits 4%? Are we going to have wage and price controls again? Of course, wage and price controls don't work because they attack the result of inflation, rising prices, not the cause of inflation, which is the monetization of debt, the quantitative easing that Ben Bernanke is about to embark on, which again is the reason for weakness in bonds, weakness of the dollar, and strength in gold. And also, I wanted to point out again, I know I mentioned on my video blog last time about the proliferation of these Peter Schiff I hate videos, and of course the minute I did that, we got quite a few more of them that sprung up, so I hate to wave a flag at a bull, but one in particular I thought was amusing to me because in an effort to discredit me, they played a quote of Dave Ramsey calling me an idiot, telling everybody I was a nutburger, that I was a kook, and of course it's very interesting because they're not playing the entire call in which my name came up, so they're taking it out of context. What happened was in early 2008, a woman had called up Dave Ramsey because her father had read my book. And as a result of reading my book, he wanted to immediately sell his Dow stocks, his mutual funds, and he wanted to buy gold. Now, of course, at the time, the Dow Jones was over 13,000. It's 11,000 today, and it went a lot lower. Gold was under 800. It's now about 1250. Now, in response to what this girl said about my book, Crash Proof, and about what her father wanted to do, that's when he went on this tirade, calling me an idiot and a kook and a nutburger, saying that was crazy advice, that there's no way the market could collapse, no way stocks could crash, that gold was a stupid investment, that he has never bought any gold in his life and that he never would, and that I was stupid for recommending gold, I was stupid for telling people to buy stocks, that she should tell her father to relax, to keep his money in the market, that what he was doing was his money, he was buying the mutual funds, and he was putting his money in fully paid for real estate, which means real estate where you put you don't have a mortgage at all, which of course was the worst way to have bought it because you can't walk away. So the reality is, that radio show, the one that was vindicated was me. I mean, I'm not the one who looks like a fool. It's Ramsey who looks like a fool for giving such bad advice and criticizing me for giving a good advice. Yet this show totally takes it out of context and doesn't let you really understand the full thing. But that's how these guys operate when they try to make these videos. And also the fact that the dollar did rally in 2008, despite the fact that I said it would fall. That doesn't just invalidate what I'm saying. It did fall. The people who got it wrong were the people who were buying the dollar in late 2008. Anybody who bought the dollar as a result of the financial crisis, they're losing money. The dollar is hitting record lows and going much lower. I was right. It's just that so many people couldn't understand it in 2008. Well, if they couldn't understand it then, they sure should be able to understand it now, given what's already happened. Anyway, that's it for today. I want to remind everybody to watch my new radio show. You can listen to it rather on schiffradio.com. It starts Monday. It will air 5 days a week, Monday through Friday, 6 p.m. to 8 p.m. Eastern Time. So again, schiffradio.com. Don't forget to tune in. Take care, everybody.